You don't buy a house with money. You buy it with your future. And the most dangerous part? The bank already knows how much of your future you're willing to sacrifice before you even sign the papers. But they won't tell you that. They'll just smile, shake your hand, and say, "Congratulations, you're approved. Sounds like success, right?" It's not, because banks don't care if you retire comfortably. They don't care if you can afford groceries 10 years from now. They don't care if you ever become financially free. They care about one thing. Will you keep making the monthly payment? That's it. So the number they give you is not your safe limit. It's their profit limit. And here's where things get dangerous. Because when they calculate your EMI, if you're a lender, it builds zero wealth for you, just silent leakage. Second, property taxes. They don't stay fixed. As your home value goes up, your taxes go up, which means your fixed cost isn't really fixed. Third, insurance. Mandatory, increasing, unavoidable, especially if you live in a risky area. Fourth, repairs. Your house will break. Not maybe, not someday. It will. A sea fails, roof leaks, plumbing bursts, and when it happens, you pay, not the bank. And finally, the cost nobody talks about. Opportunity cost, that big down payment you made. That money could have been growing somewhere else. You didn't just spend it. You gave up what it could have become. And the bank? They calculated none of this. They just looked at one thing, your income, and they gave you a number. Then come the rules. Spend 28 to 30% on housing. Keep your debts manageable. Don't buy more than 3 times your income. Sounds smart, but in today's world, those rules are breaking. So people stretch, and that's where the trap begins. Because on paper, everything still looks fine. Let me show you what that actually looks like. There's someone earning a decent income, not struggling, not rich. He buys a house slightly above what he should. Nothing crazy, just a little stretch. But after paying for the house, there's barely anything left. No real savings, no investing, no cushion, one emergency, and everything starts falling apart. Then there's someone doing well. Higher income, stable life. Buys a house responsibly. No big risks, no bad decisions. But after all expenses, she's not building wealth. She's just maintaining her lifestyle. From the outside, it looks like success. Inside, she's stuck. Then there's the disciplined one. High income, smart choices, no bad debt, follows the rules almost perfectly, buys within limits, but makes one mistake, puts too much money into the house, and keeps too little outside. Years later, a major expense hits, and suddenly, he's back in debt. The house that was supposed to build wealth starts slowing him down instead. 3 different people, 3 different incomes, same outcome, pressure, because they all followed the wrong number. So what's the right one? It's not what the bank approves. It's not even what the rules suggest. The number that matters is simple. After everything, what's left? After your mortgage? After taxes? After insurance? After maintenance? How much money is still working for your future? That's your real safety. That's your real power. That's your real wealth. Because if buying a house leaves you with nothing left to grow, then it's not an asset. It's a liability wearing a smile. So if your numbers don't work, you only have 3 real choices. Buy less, wait longer, or move somewhere cheaper. None of them feel good, but all of them are better than being trapped for the next 20 to 30 years. Because the bank will approve you. They almost always will. But approval is not protection. Approval is just permission to take on risk. So before you ask, how much house can I afford? Ask something better. How much life will I have left after I buy it? Because that answer is the one that decides everything.